Let's talk about recession and Albion's outlook on recession. Jason, you referenced recession in your remarks, and John, when we talked about the inverted yield curve, certainly that can be an indicator of recession. What is Albion thinking and seeing in terms of possible recession for 2024 or in 2024?
Sure. It's an important question. So I won't bury the lead. Are we still anticipating a recession this year? Yes, we are. Though at the same time, we think soft landing odds have gone up too. Um, when our forward indicators signaled the most caution, which was about a year ago, it was early 23, recession odds through our model were said to be quite high. Several of these indicators have improved in the time since, meaning recession probabilities have come down. But because the two highest quality indicators continue to flash red lights, and both John and Liz have mentioned one of those indicators, that's the Treasury yield curve being inverted, the other one being the Conference Board's LEI, which is their leading economic index, which is an index of 10 sub leading indicators that we think is pretty comprehensive. But because those two elements are still flashing red, we consider a recession risk to still be elevated. Also, the idea, and I've talked about this on prior calls, the idea that the Fed can take rates from 0% to 5.5% with over $1 trillion in quantitative tightening, all in a very short period of time, and that the economic pendulum will stop from strong growth to perfect growth without going negative. It doesn't make a whole lot of sense to us, and it would be somewhat ahistorical to expect that. That doesn't happen often. In any given year, the risk of recession is about 15%. So recession is always a possibility. Right now, we'd say the odds are maybe 50-50 based on the data that we're seeing. But again, there's been some diminution of that from a year ago. The odds were higher a year ago based on kind of what we were seeing at the time. So we've seen some improvement, but the odds of a slump are still uncomfortably high in our view.
But absolutely, and yet there are indicators that suggest that reduce those probabilities. Initial jobless claims have diminished, and they're at a steady rate right now of about 200,000 a week. Corporate bond spreads, which really are an assessment of what the market thinks the risk of default is among corporate bonds, have tightened, and that they're steady at a much tighter level, meaning you're not getting a whole lot more yield if buying a corporate versus a treasury, which suggests the market has a positive outlook. I think Liz already addressed, and I think Jason already addressed consumer confidence, which is stronger than we would have expected right now. It did rebound toward the end of 2023 into early 2024. So absolutely, the Conference Board issue and the inverted yield curve are suggestive of the potential for recession. It's conflicted messaging. There are plenty of indicators out there that are suggesting that the economy is doing okay as well.
Yeah, worth mentioning that each one of those indicators are in the forward-looking Albion dashboard that we use. And to John's point, those are examples of those indicators that I alluded to that have improved over the last 12 months, while LEI and Treasury yield curve have not. And therefore, why our implied odds of recession have gone from very high a year ago to, like I said, maybe 50-50 at this point. So things have improved. So I agree.